So, India got independence in 1947, but we got economic independence only in 1991. Is that India will go from capital scarce to capital surplus. So I think the first thing when we started off, we were clear that we are in this for the long term. And that's what we do for all of businesses. People are your most important asset. I think they're the only asset that you have as an organization. So we don't want to be the smartest, but we want to be the most resilient and with the most endurance kind of company in the business. So we start pretty sure by 2030, India will have a lot more excess capital to deploy than Indian economic energy. I mean, we are trying to fly with only one engine firing on the plane. The other engine needs to kick in, and that engine is the credit markets. So invest in relationships, invest in health, and invest in building your wealth. The connective tissue for good people is organization and culture. I believe that you have to constantly learn, and India teaches you a lot.
Welcome everyone to another exciting episode of Talks with Daulat, where we aim to deconstruct the seemingly complex world of finance and empower investors to take better and relevant investment decisions. My name is Varun Fatehpuria, and I'm the founder and CEO of Daulat Wealth Management. Today is a very special episode for us. We're truly pleased to have one of the early and true pioneers of the financial services industry in India, Mr. Rashesh Shah. Rashesh ji rarely needs any introduction, yet I will do my bit. He's the founder and chairman of Edelweiss Group and has over 3 decades of experience in the financial markets, helping turn Edelweiss into one of country's leading and diversified financial services organization. The company encompasses businesses across the spectrum, from a leading alternatives business to mutual funds, NBFC and insurance. Before starting out Edelweiss in 1995, he worked with ICICI, and he is an alumnus of the Indian Institute of Management, Ahmedabad. Rashesh ji, it is an absolute pleasure to have you join us on our show today.
Thank you, Varun. Very happy to be here, and thank you for having me. I think it's an exciting thing that you're doing, so very happy to be part of that.
I want to, Rashesh ji, just rewind the clock a bit and go back in time in 1995 when you were starting out Edelweiss. You come from a family of businessmen, and this is something that you've talked about publicly, that one of the motivations of going to business school was to be able to find a corporate job and stick to that. And yet you took the entrepreneurial plunge in the 1990s when entrepreneurship was not a very cool or a hot thing to do. What was the thinking back at that point in time when you wanted to, quit your stable job, plunge into this? And why do you think financial services is something that you want to do for the rest of your life?
Exactly as you said, I think the idea of doing an MBA, and I was very happy at ICICI. I actually, when I joined ICICI, my idea was to retire from ICICI. So I wanted to make a full, entire career out there. It's a great organization. I really learned a lot, grew a lot. I enjoyed, all the time I spent there. But I think a couple of things happened. If you look at India after 1991, so, India got independence in 1947, but we got economic independence only in 1991 because India's, the political structure from 1947, I think evolved, and it's been a great political experiment of, universal franchise and all of that we did. But our economic structure, which was very, government companies oriented, centralized planning, a lot of controls, all of that were there. I think that experiment, the economic experiment between 1947 to 1991, did not yield the results. And as a result of that, I think India actually got financial independence or economic freedom in 1991. So I graduated in 1989, was in ICICI, and fortunately I was in a group which was working with a lot of early stage companies, a lot of young companies like Infosys was actually one of our clients at that time, which was a very small company. So you saw that from 91 to 95, a new India was being born. And I think along with the new Indian economic structure, the Indian financial structure was also undergoing a change. So if you go back and connect the dots, NSE got formed in 94, SEBI got formed in 93, the FI started investing from 94 onwards, the private banks were allowed from 94, the private sector mutual funds were allowed from 95, insurance companies came about a few years after that. So basically between 91 to 2000, in those 8-9 years, as we restructured our economic construct of the country, I think the financial sector got reconstructed. And our hypothesis on that was that, Of course, in hindsight, it's very easy to connect the dots. At that time, it looked very exciting, mutual funds and foreign investors and equity research and stock trading and all that was coming in. So we started Edelweiss with that. It was more being carried away in the youthful enthusiasm with the excitement of this new age. I think Indian financial system that was getting born, and it has been fabulous. I mean, even in hindsight, though we were excited and very optimistic, I think even we underestimated how much the opportunity was. So I'm very happy that we got carried away with the what was happening around us and started Edelweiss, and it's obviously grown, not with complete design, but as entrepreneurially, as opportunistically as was available. But I think that was the context of how uh, from ICICI to Edelweiss happened to me.
So at one end, you talk about, the opening up of the Indian financial services industry, the economic liberalization with a lot of foreign participation taking place, a lot of, I would say, business houses and entering into the financial services industry. And yet you were 30 something, starting out with your co-founder in an industry as a complete outsider, right? Obviously, we have had a lot of sour moments at that point in time in the 90s with the multiple scams taking place. What was that specific period like? How were you able to convince people to work with you, work for you as a complete outsider with no really, I would say, connections in the industry, so to speak?
So no, the markets were very volatile between 96 to 98 with the Asian financial crisis, and all of that was a pretty bad time. 98, 2000 was again great. 2001 to 3 was bad. 3 to 8 was good. 8 to 12 was bad. 12 to 16 was good. 17 to 20 was again bad. Then COVID happened. So I think if you look at it, it's you understand the business cycles, you understand economic cycles. So I think the first thing when we started off, we were clear that we are in this for the long term, and that's what we do for all our businesses. We say that at least for 10 to 15 years, we will not rethink the decision, we'll stick to it, we'll make it work, all of that. So I think that resolve or that approach really helped us. And I think if you look at these cycles as normal business cycles, they actually can be an advantage also. You can capitalize. When cycles are down, also there's a great time to build the organization, to people are easy to hire. So the other thing has been we've been very, very fortunate. We got very good people all along. I think even now, I in touch wood, I always say that as long as we can have good people, hire them, retain them, grow them, I think all our other issues get solved. I think people are I mean, a lot of people say that, people are your most important asset. I think they are the only asset that you have as an organization. Everything else will grow, come, grow, and all that, come and go. So we've been very fortunate. We have a culture. We had a lot of equity ownership. We have ESOP structure, but we attracted some very good people over the years. We continue to attract that, and that has been, I think, one of the other strong point. And the third thing we had is we always clear that along with people, organization and culture are equally important. I mean, it's not just people because then only people is just a bunch of individuals, but it's what connects them. The connective tissue for good people is organization and culture. So invested in building an organization, governance, board. When we were a small company, we had a board with independent directors. At one point, we have 5 people on the board, 3 were independent, only 2 of us were insiders. So we also did all of that very early on, that we wanted to truly build an organization. We wanted to truly build a culture into which great people can thrive. And then I think businesses go through up and down, opportunities come and go. That was for us the second part of the equation. The first part was can we get people and organization culture right?
I want to switch gears and talk about something that is very relevant today from an investing point of view. That is allocation to alternatives, right? Whether you look at private credit, real estate, special situations, and this is an area where Edelweiss has really had a first mover advantage, saw where the puck was going, and took that plunge very early on over the last decade. And it has really been an engine of growth for Edelweiss over the last few years. How do you see the alternatives business today from your point of view? Obviously, the scale has been built up in your business over there. And do you think it will continue to be the engine of growth? It will continue to be the crown jewel, what we truly associate to the Edelweiss as in the alternative space?
So Varun, all the businesses are crown jewels. I mean, it's like having kids. I mean, all your kids are crown jewels. Some will be good in English, some will be good in maths, some will be good in something else. So I think idea is that over a period of time, all businesses should grow, become high quality businesses. At the moment, I think now the alternate asset management is coming of age. You rightly said, but if you go back 4 years ago, nobody even understood or appreciate the value of that. At that time, the wealth management business, which we spun off into the Nuama Wealth Management platform, was the crown jewel in that sense. So I think we don't think about crown jewels, we think about businesses over 15, 20, 25 years. How do we make them grow? How do we add value? Then how do we unlock that value, deliver that value to all our stakeholders, including shareholders? So that's our approach. Specifically on the alternatives, you very correctly said, I think it's been a great opportunity. So one of the things we do in Edelweiss is we do try to identify big trends, because our idea is that I think you can be smarter than others, but that is there are a lot of smart people in the world. So all along, I think our competition, everybody is very, very smart. But one place where you have an edge is identifying trends and making early bets and scaling them up into businesses over a long term. Because staying power of 15, 20 years, conviction in the business is equally important as just being very smart at execution. That is required, but there are a lot of others. So you can't outperform, but you can outbehave. And outbehave needs a lot more, patience and long-term trends and conviction and all of that. More what I call the EQ capabilities rather than the IQ capabilities only. So I think in this world where IQ is becoming more and more common, there is artificial intelligence. There are people who can, easily see and process information much faster. I think things like behavioral traits of long-term patience, conviction, building quality businesses. I think that is also in fashion, and that is the approach we want to follow. We don't want to be the smartest, but we want to be the most resilient and with the most endurance kind of company in the business. So we started the alternatives with that in 2011. And at that time, alternatives largely meant private equity. So if you look at after 2008, I think, I think between 1980 to 2010 was the era of what I call the stock markets, the public markets. We saw the Wall Street companies grow, and then we had all this, India also, a lot of the fund managers and all of them are growing, and that continues to grow. But I think with after 2008, there was a need to highly regulate them. The public markets have become very, very regulated because a lot of retail money is coming into that. And we thought the private markets is where the alternatives operate, is also a very interesting space. That is what has happened in the US. We have seen firms like Blackstones and others who have grown a lot. So that was our first hypothesis. Our second hypothesis, which is equally true and is actually still playing out, is that India will go from capital scarce to capital surplus. Indian local capital. I think after US, this will be one of the few countries where there is a lot of local capital that is available. It is going to be invested in India. It's not going to go outside and invest in China and US and all very easily. So there is a lot of local capital, and you've seen last 3, 4 years where foreigners have sold, the Indian retail investors have kept the stock market stable. So I think there is a huge amount of local capital that is available. And what the reforms we did in early 90s of changing the capital structure and the financial structure and the economic structure of the country has started yielding results now, that we have gone from capital scarce to capital surplus country. It will take another 5 years to play that out. And that when there is capital surplus, I think yields come out. As you know, the Indian stock market is one of the more expensive ones in the world, because there is a lot of capital that is chasing a few good assets. So yields come down, returns come down. So by alternatives looks at providing that higher yield, and for that you get paid. So the three characteristics of alternatives is they do uh, invest into private markets where the short term needs are not as much. You can take a long term view. Like that is why a lot of companies go private with the private equity funds and all that in the US. So I think one is they operate in private market where you can take a long term view, restructure, and not have the quarterly a treadmill to go on. B, they do earn extra yield, which is because of operating in private markets and taking a long-term view and doing maybe some short-term trade-offs of slowing down business and doing some cost cutting and all that, and then eventually creating value. And the third about alternatives is they also get you a performance fee. So what has happened in asset management is a lot of the money has moved from active to passive in the mutual funds and all, where the fees have come down, profitability has come down, and it should be so, because if you're not really getting extra returns for the shareholder, for the investors, then you should have to cut your fees. While in the private markets, in the alternative space, you can earn extra returns. And alternatives is a big space. There is private equity, there is private credit, there are real assets, there is hedge fund. All of them are what we call alternatives. Alternatives means you earn an extra return and you get a performance fee out of that. So we saw these trends play out, and our hypothesis was this: over the next 20 years, this will play out in India. I'm pretty sure by 2030, India will have a lot more excess capital to deploy than Indian economy can absorb. And I think helping Indian savers and households and institutions invest that money and get that extra yield is where the alternatives opportunity is.
So Rashesh, here you have one business which is firing on all cylinders. You're really scaling up that platform over the last few years. And if you look at the other end, the NBFC arm, the housing finance arm of Edelweiss, there has been a real consolidation in that space. You guys have had some speed bumps over the past years, but all in all, there has been, I would say, a focus on sorts of moving away from giving wholesale bulk loans to real estate developers, to industries, to building out a more granular loan book by lending out money to retail and SME audience, right? What are some of the learnings that you have from this NBFC crisis that we have seen erupt in the industry over the last few years in your previous avatar, and why the focus today on building out a more smaller and a granular loan book?
So I think what has changed in India over the last few years, that though economy has grown, cash flows of corporates, especially wholesale, like whether it's project finance or whatever, or any wholesale borrowing is there, the cash flows are irregular. They are uncertain, and that does create a lot of stress. While if somebody's taken a home loan and is a salaried individual, there is a lot more, because people don't lose jobs in India. There have not been huge amount of job losses and all, where home loans and all have gone into default. So I think retail in India is a lot more, you're catering to customers with more stable cash flows. In wholesale, our experience has been that cash flows are very unstable. Now, cash flows can be unstable, and that has been there, but then you need very robust credit markets where refinancing is easily possible. And as long as the borrower is credit worthy, there should be credit available. But we have seen in the last few years that even credit worthy borrowers, the credit markets can dry up very quickly. So India equity markets have evolved a lot, but the credit markets still are, I think, very sticky and not as evolved. We don't have a very robust bond market. We don't have a high yield market. All of that is not yet happened in India. So given those realities, I think for wholesale borrowers, whether it's corporate borrowers, project finance, real estate, all of that, in the absence of a robust refi market at a price, as well as the uncertainty of the cash flow, that asset class has become very sticky. Now, all of us learned, we assumed that, even if the cash flows are not as certain, there'll be some refi as long as the assets are good, the companies are good. But what happens in India is, I think after post 18, when the credit markets really went through almost a spasm in that sense, and then COVID happened, which was another spasm for the credit markets in India, not as much for the equity market. The equity markets recovered much faster, and I think credit market has a lot of nuances in India, because there are a lot of banks involved and depositor money and all of that. We do have a much more conservative approach in credit markets than in equity markets. Equity markets, the IPOs which come in 2,100 and then the stock becomes 800, it's now accepted. People know stocks go up and down. But in credit market, every default is, there is a lot of hulla around that. So given all of that, I think NBFCs, even mutual fund credit funds, even banks, all of them will operate where there is a granularity in terms of the asset class, so more retail borrowers, in other words, and more stable cash flow oriented borrowers. Now, that also is not good because there are good quality borrowers who may not have stable cash flows, like SME entrepreneurs. But slowly they are getting crowded out of this market of NBFC and banks and others. They will end up going to private markets, private credit market, and that's why you're seeing a blossoming of the private credit fund after ILFS episode in 2018. Now, private credit markets are good, but they are more expensive than the public credit markets. So that is what we should be aware about. So our idea in the NBFC also has been that it's not just the credit cost, it's also the ALM risk, because when markets dry up, when the bond markets dry up, when the banks, because it's still, the credit markets are not as heterogeneous as the equity market. Equity now we have FI, sovereign wealth fund, hedge funds, Indian retail investors with SIP, Indian mutual fund, insurance companies, high net worth, family offices. It's a very heterogeneous market, and we have seen that last 4 5 years. So I think our equity markets have evolved up to here, our market infrastructure, our ability to handle, crisis and all. Our credit markets are still growing. So until the credit market grows, I think any wholesale corporate borrowing, any uncertain cash flow borrowing, because you could have great collateral with uncertain cash flow, and you should be borrowable. But currently, the public credit markets will not allow that. So as a result of that, I think the idea is to move those things to private markets, which is where our alternative business is focused. And in the NBFC business, do more retail and granular, and also very asset light strategies where you have much higher ROE, but you don't build a large asset book and balance sheet on your own book.
Sticking to that, we often talk about the India growth story, the fastest growing economy in the world, a rising middle class. But for India to truly achieve its true potential, the private sector needs to step in and increase their capital expenditure. And this is something that we are not really seeing. I think part of the reason is this general risk aversion from both lenders to lend against greenfield projects, and also from borrowers to take on debt and use that for their greenfield expansion, more gravitating towards brownfield expansions, right? How do you think today, in the current macroeconomic environment, that capital gap can truly be filled? Because again, like taking on debt is something that now people are really turning their eyes away from.
Absolutely. I think you have hit the issue, on its head. Because if you think about it, uh, we have I think a strange situation. Equity markets are willing to take risks. Equity markets, you see the IPOs and even SME IPOs and all that. So you have a lot of risk capital available for equity markets, and you have the credit markets which are extremely risk covers. Everybody wants only AAA bonds and stuff like that. So we have extremely, and part of it is the aftermath of ILFS and all that. So, and ultimately all investing needs both equity and credit. You can't only have only one engine firing. And that is a situation we have right now, that a lot of optimism, a lot of risk-taking capability in the equity markets, and a lot of skepticism and a lot of risk aversion in the credit markets. Now, government has been able to do capex because government is obviously very credit worthy and the highest credit rating instrument in credit. But outside of that, even large corporates who are AAA are very averse to borrowing. Everybody says, I want to be zero debt. How can it be? Because for every project, if I raise 100 of equity, I'll do another 50 to 100 of debt. But if I don't want to take debt, I can't fund a project with only equity, because
Correct.
equity. So, and that is why, yeah, startups can happen. So, startups were getting a lot of equity because they don't need borrowing. But if you want to put a steel plant or a cement plant or an auto plant, you will need equity and debt. Equity is easily available. Equity is now, I mean, if you look at the stock market, the valuation, you can assume that equity is available. But credit is not available. And that is why we are trying to run with only one engine firing. I mean, we are trying to fly with only one engine firing on the plane. The other engine needs to kick in, and that engine is the credit markets. And that is where currently the whether you call it private capex or whatever is not as much. And we have seen, retail credit has grown a lot, but that's not so much for investment. That has been largely for consumption. but we need credit for investment growing in the country. And if you look at, so you don't look at credit growth, you look at the credit growth, which is for investment and for business purposes. And that is slowly and steadily, um, I think, becoming risk averse, both on the borrower side and the providers of credit side.
Great. Yeah, absolutely. I think that is something that when we also go and speak to a lot of the clients, I think just from a fixed income allocation point of view, whether from our corporates, I think that credit understanding is still something that needs to be there, right? Finally, I just want to touch upon last two questions. How do you see the future of Edelweiss? There has been a refocus of sorts for the company where now the focus is more on becoming a holding company, incubating businesses for 15, 20, 25 years, unlocking that through a liquidity event like what we saw with your wealth management platform Nuvama, and then rinsing and repeating that. So where do you see, like today, now you have turned 60 and you have another 20 years of career, 25 years of career ahead of you. How do you see the future of Edelweiss going forward?
So I think, as you very correctly said, we have pivoted from an operating company to an investment company. We don't like a holding company. So in India, there are holding companies where you hold for 100 years because these are family holding companies where you want to keep it control in the family and run that and hold it for 3 generations, 5 generations. That is where holdcos are structured. So, and then there are P funds who have a 3 year, 5 year kind of a view. We call ourselves an investment company. I think it's a new animal in India, but we call it an investment company where we incubate and invest into businesses. So we don't always incubate, we also invest into businesses. Uh, when we also incubate businesses, and idea is to create value. I think if you can invest for 25 years and create, 50x to 100x of what you invest into that, all those are great opportunity. India does present that opportunity because India is where the US was in maybe 85, 89. The US became a $4 trillion economy in 1989. India is today becoming a $4 trillion economy. So I think from now to whether you look at 2035 or 2050, there are businesses to be built, especially in financial services. There are a lot of adjacent market, but all of them need capital, a little bit of capital, staying power, execution capability, all of that. I think Edelweiss has shown that in the businesses we've built. So our idea is, can we be an investment company which incubates and invests into businesses, focus more on capital allocation, management team hiring and performance evaluation of those, and looking at long-term strategy, providing all that rather than being an operating company which operates and executes all that. So that is why my role has changed. I focus a lot more on strategy, capital allocation, governance, management hiring. But we have very good CEOs of all the businesses, and we have seen on the Nuama front that has been spun off. It's been independent for the last couple of years, though it got listed only about 5, 6 months ago. And it's been a fabulous experience. I think there are a lot of young, smart people who can grow businesses, who can execute, who can focus. So I think this unbundling of Edelweiss has created focus, has infused energy, has created a lot of empowerment for our leaders. So, and that is what we want to do. We in Edelweiss don't want to focus on control of the companies. We want to be an enabler. We want to enable the companies to grow, empower the CEOs, and we are focused on value creation. We are not doing this for altruistic reasons. We are doing this to create value. We are shareholders. I think insiders today still own almost about 40% of the company. And fortunately, we are at a stage where the management team, which is me and Venkat and our management team, are also shareholders, and hence our approach is aligned with shareholders to create value and unlock value. Maybe a few holdcos create values, but don't have to focus on unlocking value because keep it for 100 years. A lot of the PE funds have a 3 to 5 year view, and they are very smart and very good at that. But in India, if you want to take a 15, 20 year view, that has been the sweet spot because that is the one thing that is a gap in the market. And as I said, if we can focus on that, we want to create that. And it's not about me when I retire, but I think Edelweiss as a platform, can we be, an investment company that invests, incubates businesses, allocates capital, focuses on management team, performance, all of that, and grow that. And when the value is created, give it back to the shareholders.
Great. Yeah, that's a very good point. And finally, for more of a younger audience today, I mean, you've been in this industry for about 30 years, right? Today, if you were to start Edelweiss all over again in 2024, what would you do differently, knowing what you know, having had your hair grayed in this industry, he's really seen the entire cycle of the financial markets in India. What would you do differently today if you were starting out?
I would answer it in a slightly different way. I think some things you will do differently and some things you will have to continue to do in the same way. I think what I would do, differently is truly, I think, look at India over 20, 25 years and form hypotheses and assumptions on that. Be very patient about it. I think there are opportunities in India in the smaller towns, tier two, tier three, tier four, but everything takes 8, 10 years. So have the patience, have the commitment, staying power for that. You obviously have to grow, you have to have aspirations, but everything takes time in India. But when it hits an inflection point, it goes very fast. So it's not always a straight line. It's like this, a long incubation stage, and then you become from caterpillar to, butterfly. Uh, so as you know, there was one very famous actor in the US who said, it took me 20 years to become an overnight success. Uh, So I think that kind of an approach is what is required in India. I've learned it along the way. I wish I had that. So that is one thing I would say. The second thing I think, but it is the same thing that continues, is I believe that you have to constantly learn. And India teaches you a lot. So if you can build an organization that is focused on learning. So we make a lot of mistakes. We made a lot of mistakes. Our whole approach is what have we learned? So every time we analyze a mistake rather than, have any, any post-mortem and any uh, really accusations of why we made the mistake, who made the mistake, all of that. We focus a lot more on what did we learn out of this and constantly ask, what did we learn? What did we learn? And you should be humble enough to say you will have to learn. Nobody knows everything. So I think that is one thing. And India will teach, because India can be volatile, India can be uncertain, India can be chaotic. So you can be a smart guy, you can be very, very clever, but India will still has a lot to teach you. So if you have to be willing to learn, only then you can get the benefit of that. So I think I would do the two things. I would believe uh, a lot on the retail opportunity in India. I think people have underestimated, people continue to underestimate that. So retail tier two, tier three, tier four opportunities in India are going to be very big in the next 25 years. So if you can, put your bets on that. Again, what would remain same is people. I think get the best people around you that you can and continue with that. And the last thing I would say is India is creating a lot of wealth. A lot of entrepreneurs are creating wealth. I know a lot of startups and a lot of other people. Over the last 30 years, I've seen a lot of people in the markets also create a lot of wealth. But I think sometimes we all try to sequence things in life. And I've seen that three things are very important: wealth, health, and relationships. And but a lot of us assume that first I will get wealth out of the way, then I'll focus on my health and my relationships. I would advise people that focus on all three at the same time. Start as early as possible, because health is as important as wealth, and relationships are as important as the other two. So invest in relationships, invest in health, and invest in building your wealth. Do all three of them at the same time. It's a constant alignment and it's jugglery that you will have to do, but don't delay that. Don't sequence that, because suddenly you will be 45 years old and you have realized that you create a lot of wealth, but your other two things are under invested in. So those are the things I would advise my own self 30 years ago.
Great. Thank you so much, Rasheshji, for doing this, for parting us with some words of wisdom. We often, like to have a crystal ball gazing into the future, but we not spend enough time looking at the past, learning from the industry. And this is exactly what you have done for our audience today. You have given a color on your own experience in being in this very vibrant industry, in this vibrant country like India, and what the future entrepreneurs can learn from an individual like you, that it really takes patience. There is no such thing as an overnight success. Building businesses from the ground up, as you have shown, takes time, takes perseverance, and most importantly, takes a huge amount of grit and confidence in your one's own ability. So thank you for showing that to us. Right, I think it's no easy path going forward, but I think if we can learn from those experiences, like stalwarts like you, I think India's in a much better shape going forward. So Thank you so much for doing this. And for all of our audience, I hope you can take a lot from what Rashesh ji has had to say today. We did not had a standard fund manager conversation today talking about markets all the time. We wanted to do something really different, bring an expert who really truly understands the nuances of what it means to build a financial service company in India. So if you like this podcast, feel free to give us a thumbs up. And if you would like to learn more from us, feel free to drop a comment below.
Excellent, Varun. Thanks a lot. And thumbs up to you and all the listeners out here. Thank you very much. Really
Thank
enjoyed
you.
it.
Yeah.
Bye.